One of the kind of juiciest setups was on the New Zealand dollar. We had this approach of this major support level down at 65.30, and as we approached that level, we fell off a cliff. Basically, there was a big, strong, bearish move with no pause, no support whatsoever. We hit that level like a brick wall, and the way that you would have attacked this is to wait for that kind of conservative double bottom, and you actually got a beauty of a double bottom right here. We tested the low but didn't break and close below the low, so you would have got that perfect test there. You would have seen the divergence on RSI as well, so we went oversold. We had nice strong divergence back into 29, and then we had equal tests of the low. Price gave you equal lows, divergence on RSI, and then boom, rocketed away. So there was your confirmation. The thing that you see a lot of traders do is they put so much effort into their entries. Where is the highest probability set up for a trade where it's going to move? Now, whilst that's really, really important, you've also got other orders to put the same amount of effort into and the same amount of analysis into, and that is your target taking, meaning you want the order to be filled in a high probability move, so a quick move as possible. You don't want to be stuck in a trade for ages and ages, but you also want it in a position where it's likely to be filled, right, without hitting any resistance or support and then kind of being in a trade longer than normal. Second of all, your stop loss needs to be in a place where it's got enough breathing room, and again, it's not likely to be stopped out, but still maintains a good reward to risk profile. So you want to put the same amount of analysis into where your targets are going and your stop losses are going. And I think that video yesterday, I showed how you use Fibonacci and other confluence to do that, but I think it's an eye-opener for a lot of people, because I don't think, well, I know many traders don't think of it like that. And it's absolutely essential that you treat every order the same. You want to, if you're allowing for spreads and your front running orders, you need to do that on your entries, your stops and your targets, because otherwise they're all orders, right? And your stop loss is someone else's entry order, and your target order is someone else's stop loss, and and so on and so on. Every sell is another person's buy, and every buy is another person's sell. All right, that's the best way to think about it. So in the stock market, for instance, it's not the same as the Forex market. The stock market, there's limited shares, okay? There's a market cap, there's a limited shares, and there's a number of shares outstanding. And the idea is you buy, and then you own those shares, right? And then there's limited shares. There's being able to identify the highest probability zones where there's going to be some kind of reaction, either support or resistance. That's really all it is. That's all it's made up of. Supply and demand zones that are common and patterns that play out frequently, and then build rules around and build added confirmation and confluence around that move and how to capitalize on that move over and over and over again. And that's it. And ideally you win 100% of the time, but that's unrealistic. You're never going to do that. So you get a happy medium with how often you're right over how often you're wrong, and how much you win when you're right as opposed to how much you lose when you're wrong, okay? And then to bear in mind on top of that is, when can I consistently trade this system, and does it suit my lifestyle and my personality? That's all a trading system is. And if you can do that, and if you can find one that hits that sweet spot, you'll do phenomenally well in the Forex market. Most people can't be bothered. That's the truth. Most people can't be bothered to develop a system that does all that stuff. That's why they don't. That's why they don't make money consistently over a long period of time. It's nothing to do with you can't make money trading. It's gambling. Blah 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 blah. The broker's out to get your money. No one makes money trading. No one blames themselves. Sorry, everyone blames the personal trainer. Oh, the personal trainer was crap. The great thing, it's kind of a humbling thing about being a trader of any sort, is there's no one to blame, unfortunately. You can make money or you can't make money. It's all on you. The market has done what the market's done for years and years and years. We've got a graphical representation of what it does and what it has done over the last decades and decades. So now it's up to you to pick one of those frequently, common patterns and build rules around it so you can consistently make money. And then all you got to do is trade it through drawdowns, through winning streaks, and it's only on you.